to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, July 9, 2026. We're Alina and Marcus.
So imagine a scenario where a massive military strike in the Middle East happens overnight, right? And Wall Street wakes up, basically yawns, and just decides to buy more computer chips instead of oil.
Which is, it's a bizarre, almost paradoxical reality that we're looking at today. We're dealing with a market that is suffering from this profound split personality, really.
Yeah, exactly. And we're going to break down the 4 critical themes driving this divergence for you. So first, we are watching this artificial intelligence capital expenditure supercycle completely, just overpower global geopolitics.
Right. And second, we are tracking a major pivot in the Federal Reserve's inflation narrative. Central bankers are now explicitly naming data center power grids as a primary driver of sticky consumer inflation. Third, from our daily desk data, we're monitoring a tangible fracture in the domestic economy. It's what we're calling a consumer crack, and it's showing up as very clear weakness in traditional retail and staple companies.
And fourth, our models reveal a severe mechanical de-risking event happening right under the surface of the market. You have quantitative hedge funds aggressively unwinding positions, even as the headline indices, project this broad strength.
To put it bluntly for you, this is a tape that is entirely willing to ignore literal missiles flying in the Middle East so it can blindly chase data center investments in the United States.
Yeah, and our core mission for today's briefing is decoding whether this massive divergence is justified by the underlying economic reality or if it's a sign of dangerous late-cycle complacency.
Right. So let's start with the macro environment and global rates.
Looking at the domestic bond market today, the 10-year U.S. Treasury yield dropped 4.3 basis points to 4.50%, and the 2-year dropped roughly 4.1 basis points, landing at 4.164%, which is a notable shift, right?
Yeah.
This specific dynamic in the Treasury market is what we classify as a bull steepener in the yield curve.
Yeah.
And it serves as a crucial piece of evidence for how institutional capital is interpreting both those geopolitical risks and the domestic economic data we just outlined.
Well, before we delve into the broader implications of that, let's establish the mechanics here for the listener. What exactly creates a bull steepener, and, how does it change the calculus for someone structuring a portfolio right now?
Sure. So a bull steepener occurs when short-term interest rates fall faster than long-term interest rates. The bull designation refers to the fact that bond prices are rising because yields and prices share an inverse relationship.
Right. So when investors buy bonds, they drive the price up, which pushes the yield down.
Exactly. And the steepener aspect means the gap or the spread between the 2-year yield and the 10-year yield is physically widening.
Okay. Got it.
For investors, this typically signals that the broader market expects the central bank to cut short-term policy rates in the near future, often to, support a decelerating economy.
Well, long-term inflation and growth expectations remain anchored higher up the curve.
Correct.
But that domestic expectation, it stands in stark contrast to the international policy narrative. Because when we look across the Atlantic, we see a highly divergent picture. United Kingdom gilts faced intense selling pressure today.
Yeah, they really did. And that sell-off was triggered because the Bank of England's chief economist explicitly stated on the record that their rates will need to rise to combat lingering inflation.
Yet, just across the border, Germany's 10-year Bund rallied, with yields dropping to 3.093%. We are seeing major structural disagreements on monetary policy, depending entirely on which sovereign border you cross.
Which brings us back to the domestic policy narrative, because the Federal Reserve's internal calculus took a significant turn today.
Right. New York Fed President John Williams issued a highly specific warning regarding the structural drivers of inflation.
Yeah, he stated that AI-driven demand, specifically the immense continuous draw on physical electricity, software infrastructure, and memory components, is now his primary inflation concern.
And institutional consensus is currently projecting this specific thematic demand could add a full 0.5 percentage points to core U.S. consumer inflation by the end of this year.
Meanwhile, his colleague at the New York Fed, Roberto Perelli, attempted to calm the funding markets by noting their ample reserves framework is well equipped to handle structural shifts in money market demand.
Let's pause on that AI inflation commentary from John Williams, though, because we need to break down that transmission mechanism. We often think of artificial intelligence as, code in the cloud, something purely digital.
Sure.
How precisely does the physical build-out of AI electricity infrastructure translate to sticky, persistent inflation for, say, a family paying bills in Ohio?
It comes down to physical infrastructure and hard energy limits. A localized data center designed to train frontier models requires continuous, massive gigawatts of baseload power. And to deliver that specialized power, utility companies are forced to rapidly upgrade the physical grid. We're talking about laying heavy new transmission lines, installing multi-million-dollar transformers, and enhancing baseload power generation.
Those are multi-billion-dollar, decade-long capital expenditures.
Yes. And utility companies operate as regulated monopolies. They don't just absorb those massive infrastructure costs out of the goodness of their hearts.
No, they take those capital expenditures to their state utility commissions and pass them directly on to their ratepayers.
Exactly. So a massive technology company building a hyperscale data center in a specific municipality effectively forces the local utility to raise residential electricity rates to fund the necessary grid upgrades.
Plus, the sheer raw demand for copper wire, liquid cooling equipment, and industrial real estate, it drives up physical input costs across the broader construction economy.
Right. It operates as a localized, physical inflation shock, driven entirely by a digital product. It completely alters the Federal Reserve's policy calculus because central bankers cannot fix a structural copper shortage or a heavily constrained municipal power grid simply by holding interest rates higher for longer.
Right. The physical world is entirely dictating the monetary reality.
Yeah.
And that physical inflation shock doesn't just stay in the macro data, it bleeds directly into the stock market. Moving to today's data,
We can see exactly which sectors are cashing in on that physical build-out and which sectors are cracking under the weight of higher costs. Looking at our latest run of the broad indices, the S&P 500 closed at 7,543, gaining just under 1%.
and the NASDAQ 100 rallied over 1.5%.
Yeah, and the Russell 2000 was up over 1%. But the undisputed heavy lifter today was the semiconductor sector, with the underlying index surging past 3%.
The specific corporate movers within that semiconductor space tell a very clear story of capacity expansion. Micron, trading under the ticker MU, surged 4.5% intraday. And that move followed their announcement of a $250 billion United States investment commitment extending through 2035. I mean, that is a staggering deployment of capital, larger than the gross domestic product of many countries.
Yeah, aimed directly at capturing next-generation memory demand. And the international appetite to fund this hardware cycle is equally intense. SK Hynix, trading under the ticker SKHY, priced its NASDAQ United States listing at $149 today.
Right. Our tracking notes, it was 7 times oversubscribed ahead of its Friday debut.
Exactly. When an Asian memory giant lists in the United States and sees that level of immediate, ravenous institutional demand, it confirms that global capital is aggressively chasing this cycle, regardless of valuations.
We also saw Comfort Systems USA, ticker FAX, receive major institutional consensus upgrades today. This is fundamentally a traditional industrial HVAC company, but they now derive 56% of their top-line revenue from data center cooling exposure.
Right, but while the industrial and infrastructure side of the economy is booming, the consumer side is showing severe fractures.
PepsiCo, ticker PEP, fell 2% today, following a notable North American profit miss. Management specifically cited a structural shift in consumer purchasing habits.
And Costco, ticker COST, reported decelerating foot traffic both domestically and globally.
People are officially putting down the name brand snacks and skipping the bulk warehouse runs to save money, while Wall Street acts like the entire economy runs on microchips.
Yeah, and looking at the credit markets, Capital One, ticker COF, Synchrony, ticker SYF, and Discover, ticker DFS, are all showing highly elevated implied volatility ahead of their upcoming earnings reports.
Signaling that options traders are bracing for higher default rates among subprime and near-prime borrowers.
So you have a deeply bifurcated economy. The market is bidding up specialized air conditioning companies because they serve as tech giants, while simultaneously pricing in higher default risks for consumer credit cards and selling off staple food companies.
And that sharp bifurcation is triggering severe mechanical reactions under the surface of the market. Our data shows that systematic quantitative managers experienced a 3.6% drawdown today.
Which, to put the magnitude of that move in perspective, is their worst single-day drawdown since the summer of 2025.
What exactly forces a drawdown of that magnitude when the broader stock market is up? Like, what are the mechanics there?
We're witnessing a purely mechanical unwind of crowded momentum trades. These quantitative funds operate on volatility targeting algorithms.
Okay.
When market volatility breaches a specific mathematical threshold, the code automatically hits the sell button to reduce gross exposure. They are mechanically forced to de-risk, regardless of how strong the underlying company fundamentals might be.
Concurrently, fundamental managers have slashed their long exposures, pushing their gross leverage to the bottom deciles over the past 12 months.
Exactly.
It's like cleaning out the institutional closet. Think of systematic hedge funds like a household thermostat. When the market temperature or volatility gets too hot, the air conditioning kicks in automatically. They are mechanically forced to dump their crowded consensus trades because their risk models are flashing red.
Right.
But those discarded shares aren't just vanishing into the ether. Retail investors in active exchange-traded funds are standing right underneath the vent, eagerly catching all those discarded shares.
Yeah, our tracking shows United States active exchange-traded funds are seeing massive inflows right now, capturing roughly 40% of the $1 trillion in year-to-date inflows.
The institutions are mechanically selling, and the public is aggressively buying the dip.
Indeed.
Let's transition to the physical commodities market and hard assets, because the price action here today was deeply counterintuitive given the broader geopolitical backdrop.
Energy markets saw a highly aggressive sell-off.
Okay.
WTI crude plunged nearly 4% to $71.81.
Brent crude dropped over 4% to $76.10.
And natural gas slid over 6% to $3.12.
Meanwhile, the metals complex moved in the exact opposite direction. Gold climbed over 1% to $4,123.64.
Silver jumped nearly 3%, and copper rallied nearly 2%.
We have to provide the geopolitical context for those energy moves because it makes the crude oil sell-off look entirely disconnected from physical reality. The United States military hit roughly 90 targets in Iran overnight.
Yeah.
As a direct result of that exchange, commercial shipping in the Strait of Hormuz ground to a near halt today. For context, the Strait of Hormuz is only 21 miles wide at its narrowest point, and roughly 20% of total global oil consumption passes through that specific choke point.
Right.
If transit is essentially paused, isn't the energy market playing a highly dangerous game of chicken by selling off crude oil so aggressively today?
It certainly appears highly complacent on the surface. Dealer desks are pricing this overnight military exchange as a strictly tactical and contained conflict. The market is making a calculated, probabilistic bet that neither side desires a prolonged structural disruption to global energy flows. Therefore, commodity traders are rapidly stripping the geopolitical risk premium out of the crude contract, assuming the Strait will resume normal operations shortly.
Okay, but that seems like a massive assumption.
It is. And your skepticism regarding the underlying energy dynamics is entirely justified when we look further down the supply chain at the actual consumer level.
Because the wholesale price of unrefined crude oil dropping does not automatically mean the price of refined gasoline at the pump is dropping for the consumer.
Correct. Our internal tracking highlights that retail fuel crack spreads remain at record highs. A crack spread is simply the profit margin a refinery makes by taking a barrel of raw crude oil and converting it into usable products like gasoline and diesel.
Right, and right now, there is a $128 per barrel gap between global retail fuel prices and Brent crude.
Exactly. This means that while wholesale crude sold off sharply today on geopolitical optimism, actual downstream fuel inflation has not retreated at all.
Refineries are capturing immense profit margins and passing pricing power directly to the consumer, which feeds right back into the sticky inflation narrative John Williams warned the market about earlier today.
On that point, we need to connect the dots across these macro rates, the stark equity sector divergences, and the commodity anomalies to define the actual market regime we are operating in.
Right, the synthesis.
The big picture synthesis is that the broader market is locked into a soft landing plus AI capex trance. Both the equity and treasury markets are mutually confirming this highly optimistic narrative.
They are actively choosing to entirely ignore severe geopolitical flare-ups. You can see it clearly in the plunging oil prices and a VIX volatility index that remains remarkably suppressed at 15.84.
Yep.
And they are completely glossing over the traditional consumer softness we highlighted with PepsiCo and Costco. The market is operating with intense tunnel vision, focusing solely on the structural multi-billion-dollar spending of the major hyperscalers.
And we can see the deep sophistication of this institutional positioning clearly reflected in the gold market. The persistent strength of gold, pushing well above $4,123, combined with the extreme strength in technology equities, tells us something highly specific about institutional sentiment.
That they aren't just buying it for safety.
Right? Investors are not buying gold purely as a fear gauge or a panic hedge against the Middle East. They are actively utilizing gold as a real yield play and a hedge against the structural depreciation of the dollar, betting that the Federal Reserve will be forced to tolerate higher structural inflation to accommodate this massive technology transition and infrastructure build-out.
Which leaves you with a critical, forward-looking paradox to mull over as you adjust your own portfolio positioning. We have established that artificial intelligence software is fundamentally deflationary for global productivity.
Yes, we're seeing highly capable open source models rapidly deploying out of China, driving down the fundamental cost of digital labor, coding, and copywriting globally.
But at the exact same time, the physical reality of building that AI infrastructure is radically inflationary for the United States domestic economy due to the unprecedented demand for raw electricity, industrial land, and specialized cooling hardware. So, are we entering a permanent divided dollar regime where United States domestic interest rates must structurally and permanently detach from the rest of the developed world just to manage this unique, localized infrastructure burden, while the rest of the world reaps the deflationary benefits of the software?
Understood.
To quickly recap today's briefing for you, the broader market entirely ignored military strikes in the Middle East, opting instead to aggressively chase semiconductor investments following Micron's massive $250 billion capital commitment.
The Federal Reserve has officially put data center power grid strains on their inflation watch list.
And while traditional consumer staples are cracking under the weight of higher localized costs, retail and institutional flows remain heavily and perhaps stubbornly biased toward the AI infrastructure supercycle.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.